welcome to another 25 minutes of the only weekend business program, Capital Market, right here on Channels Television. I'm Laddie Williams. As usual, let's begin the show with a quick review of major global stock markets performance at the end of the week. That was trading day for yesterday. We see European stocks closed lower as investors digested the Labour Party's landslide UK election victory. We see the UK's FTSE 100 index closed 0.45% lower, while the broader pan-European stock 600 index provisionally finished the week 0.26%. We see the DAX, though, 0.14% up. That's the only green right there in markets we track. To Asia now, Asia-Pacific markets were largely lower on Friday, with Japan's Nikkei 225 paring gains after crossing the 41,000 mark and hitting fresh record highs. The Nikkei saw a volatile session and ended the day, we see it was flat there for the Nikkei, 40,912 points, while the Shanghai Composite was down 0.26%. So it was mostly red with the markets we track in Asia, with the Hang Seng Index down a big 1.27%. We see Japan's household spending for May unexpectedly dipped 1.8% in real terms compared to the same period last year. Economists polled by Reuters had estimated a 0.1% rise. Household spending data is a key metric for the Bank of Japan to assess its goal of realizing a virtuous cycle of rising wages and prices. Taking on to the U.S. now, the S&P 500 rose to a new high on Friday, posting a record close as the latest jobs report reignited hopes for rate cuts from the Federal Reserve. The broader market index also advanced by 0.54%. And we see the S&P the Nasdaq was up about 0.90%. All right, let's take the conversation forward now. We review the U.S. market and part of local boss. Olumide Additional joins us now, a financial market analyst. Olumide, great to have you.
Yeah, good evening, Laddie. Thanks for having me.
So we see the U.S. indexes, we see it hit highs on Friday. And this week we had the latest jobs data for the U.S., about 200,000 jobs from the data we see there. Any pointers to the U.S. Fed rate decision for the second half of 2024?
Yeah, Laddie, I think I'm sticking with top-tier banks like Goldman Sachs. The outcast is that it's very likely that we might not see any interest rate cuts because, the retro was this year. It was anticipated that the Fed would make at least 3 cuts, and we've seen the U.S. economy firing on all cylinders, and inflation still looks quite sticky. The narrative is that inflation report is not transitory, and that's why the last discussion by Fed Jerome Powell this week, he highlighted that they are not in a rush to reduce interest rates until the 2% inflation target, and that's why we saw some volatility in the market. But I think the big stocks have been quite immune. You look at Microsoft and Apple, they are nearing the 3.5 trillion market value. That's the highest ever. Though we saw pullbacks from NVIDIA. NVIDIA had some pullbacks, losing some billions, where it's floating above slightly $2 trillion. So I think the concession is that what investors are really looking at is that how the election will play. I think that's what is really on the mind of investors. We'll see what happened in the United Kingdom. We'll see what's going to happen in France tomorrow. So investors' perception right now is the political position of the U.S. economy right now.
All right, so what are you expecting for U.S. markets next week? Any market-moving data we should be looking out for?
Yeah, there's some Fed chiefs will speak. We'll be waiting for some economic data. But I think, interestingly, where investors will be looking on to it 2 weeks from now is Tesla's results. You could see that Tesla was the shining star this week. It's up by more than 27%. And that's pretty much because their deliveries are on spot. We saw the Chinese government listing Tesla as the only foreign car among procurement. So that's really elevated hopes. So I think investors pretty much are quite comfortable with what they're seeing on Tesla. But I think the concern is that has really dragged on small and medium stocks, which have really suffered badly this year. So So I think those economic data will really point, particularly the retail and OPEC inventory data around commodity stocks.
All right, talking about some stocks that were hammered during the first half, do you see any undervalued stocks as we were in the second half of 2024 in the US?
A lot, but you see, Boeing, for example, has a management problem. You look at Nike; they pull back from Nike because of the dismal earning results. I think Nike has a strong prospect because you look at the Olympics coming up some weeks time in Paris and look at their position in the sporting industry. I don't see Nike not really coming spot on in the future. You also look at the healthcare. Pfizer. Pfizer has been trading below $30 for a while. I think with their new drugs coming to the pipeline, that really might really elevate. And also, look at Coinbase. Coinbase has not been able to break above the 250 resistance level, and pretty much because of how we saw the crypto market reacting. So I think elevations will be made when the dynamics of this fundamentals change largely. But I think those stocks should be watched on the radars of investors.
What about the weight loss drug makers at this time? We know the weight loss drugs are getting a lot of attention, even in the social media. Should we be looking at those stocks?
These stocks are very volatile. You look at the positioning of hedge funds and institutional investors for this stock. While, yeah, you could say that these stocks are interesting too, but I think investors should really look at getting market guidance and taking a very cautious look, because the fundamentals of these stocks cannot be compared with those blue chip or the ones pretty preferred by value investors.
All right, we'll definitely be watching out for what plays out next week. Thank you so much, Olumide Adesina, financial market analyst. Thank you.
Thank you for having me, Daddy.
And back home in Nigeria, see the NASD OTC securities markets performance ended the first trading week of July positive, as the index is up by 0.52% today, while the market cap closed at 2.11 trillion naira. At the same point, the volume of securities traded this week was down by 95.91% to 1.6 million units, while the total value of transactions for the week was also down by 1.2 billion naira, while the number of deals carried out was also down at 30.94% week on week. Top advances for the week are Purple Real Estate Income PLC, Fryzen Campina, while Aradale Holdings, which was the top decliner and the most traded security for the week. And to the domestic market now, ended the first trading week of July in the red, no thanks to profit taking on some bellwether stocks. As a result, the market's main index fell by 0.04%. Even though it started the week quite marginal, bringing the month-to-date and year-to-date performance 0.04% and 33.77% accordingly. Veritas Capital Assurance PLC topped the list of gainers with a 25% price appreciation. UPDC Real Estate Investment Trust led losers, down by 17.43%, while the trio of Fidelity Bank, Universal Insurance PLC, and GTCO were the top three traded stocks this week. Well, according to the World Investment Report for 2024, prepared by a team at the United Nations Conference on Trade and Development, that's UNCTAD, globally, foreign direct investment decreased marginally by about 2% to $1.3 trillion in 2023. This headline figure was affected by significant fluctuations with financial flows through a few European country economies. Excluding those countries, global FDI flows were more than 10% lower than in 2022. Well, join us now for analysis is Matilda Defalujo, the investment research analyst at Meristem Securities Limited, joining me via Zoom. Great to have you on the show. Great to have you, Matilda. So we see a global trend with declining foreign direct investment.
Thank you very much for having me, Ladi.
Yeah, it's great to have you. So looking at Nigeria's capital importation report, we saw a decline with FDI but FPI definitely took the shine, looking at that data. Are we merely just following the global trend at this point?
The global reports, and basically what it focuses on is trends in FDI worldwide, and at different levels. We see at the regional levels and at country levels too. So it weakened for the second straight year, as global FDIs fell by 2% in 2023, and if we exclude some European countries, we see that the decline comes to about 10%. So basically, just like you said, some of the issues that were highlighted as the reason for the decline, weakening growth prospects, different continuation of tensions over trade and geopolitics. And, we also see different multinational companies and enterprises also, taking a more cautious approach, to overseas expansion due to different factors like I've listed before: expectations for growth, geopolitical tensions, even supply chain diversification. So when we streamline this down to Africa, we see that all of the regions except Southern African region experienced declines too, so that we see a trend already, from the global down to developed economies, down to developing economies, and also bringing it down to Nigeria. We saw the capital importation numbers where FPIs took the shine. FPIs, as foreign portfolio investment, came in as the largest component of total importation with a 61% share. So I would say that it's a global issue at this point in time.
Is it unconnected with high interest rates? We know the global central bankers have been fighting to tame inflation. We see some of them actually winning that battle at this time. Would you say that impacted most of the FDI flows?
Yeah, I would say yes. Let's use Nigeria as a case study, right? So in Q1 2024, we saw about 600 basis points aggressive hike in the MPR, that's in Q1 alone. And this led to significant increases in yields on government securities such as FGN bonds, treasury bills. And this led to, a much more, made fixed income instruments much more attractive to foreign investors. So when we compare the returns that investors are able to get on, fixed income, short-term investment, compared to different FDI projects, I would say that, it gives them much more return. And also looking at the yield on bonds. Now, looking at the yield curve on the short term, on the short end of the curve, we have yields rising as high as 20%. But when we now look at on the longer end of the curve, yields are as low as 17%. So I would say that the high yield environment created like an arbitrage opportunity where, foreign investors can, earn much more returns by investing in the Nigerian financial markets rather than committing actual capital to long-term projects. And so that's just speaking to the interest rate environment. And I also believe that there is the aspect of cautious approach by investors. So, we know, different clamors about the uncertain macroeconomic outlook, different risk perception in Nigeria. So this has also led some foreign investors to hold off on new FDI commitments in Nigeria. So I believe that investors are taking what I would call a wait and see approach, and they're also exploring less capital intensive modes of entry, such as what we saw in the data portfolio investments. And I think that another thing that investors are also looking out for, aside the interest rates, or at least the higher interest they are able to get on the shorter end of the curve, or at least on short-term instruments, is also ease of doing business. What is the ease of doing business like in Nigeria? So, and we've seen different exits of multinationals in Nigeria. In Q1 we saw Bayer Pharmaceuticals. We've seen different exits, right? So Nigeria has what these investors want. We have the population, we have the people. People are ready to buy. But then, how easy is business like? how easy is the business environment? There's also concerns about FX, exchange rates, different volatilities, and different concerns in the real economy.
So I guess at this point, businesses have their concerns, and we see consumers also with their concerns at this time. But we'll take a quick break now. We still have Matilda with us. She'll still be with us later on in the show. And definitely when we come back, we're going to dig deeper into what played out in the market and how all of this FDI flow at this point, how that's impacting capital markets globally. That's our next conversation. Just stay with us. Welcome back. Well, we're still discussing FDI flows in the global market and right here into Nigeria. And now we've been talking to Matilda, investment research analyst at Meristem Securities, still here with us. Thanks for staying on, Matilda. So looking at the FDI flows globally and locally, how does this impact Nigeria's capital market? What are you expecting, for the stock market in the second half of 2024?
Right. Well, so the exit of FDIs and entry of FPIs means we have a lot more hot money in the system, right? And it means that we see much more activity on the shorter end of the yield curve. So this means that we are likely to see more money market activities, more fixed income activities than maybe the equities market. So, we've seen different activities, especially looking at last week. It started positively. That's the week that just said they started positively. But then we saw FBNH gain between Monday and Wednesday. We also saw some crosses on Guinness, bullish investor sentiment on Fidelity because of the rights issues. But then towards the end of the week, we saw profit-taking activities become full-blown on Thursday and Friday, especially on tickers that had already shown signs of recovery before now. So I would say that while we'll see, much more, play on the shorter end of the curve, I believe that investors would still, look at sectors that portend different attractive opportunities, investment opportunities for them, especially the banking sector. I would say for free right now that the banking sector is where all of the activity is right now. Access Bank is supposed to come up on Monday with their rights issues, and I believe that there would also be more rollouts of different announcements by other banks. We're expecting to see even much more gain on tickers like GTCO, Zenith. GTCO is also expected to hold their facts behind the offer on Monday. So I believe that investors would continue to, plug in their funds in the banking sector and also other tickers that, would help them yield different returns, high returns.
And looking at how attractive, the yields are at this time, even going into the second half of 2024, for investors that are still on the sidelines at this moment, would it be a better strategy to just go underweight equities and just go overweight fixed income?
Well, okay, so I think while it is interesting and important to look at what is going on currently, there is also the fact that investors are also forward-looking. They are also forward-thinking. So we expect inflation to moderate, next month, in the next coming months, and the impact of this is that is supposed to, the monetary authorities are supposed to, be less aggressive or at least start easing, rates. So what this is going to do is that while rates would, fixed income yields to continue to be attractive, we expect some moderation in yields, which is positive for the equities market, and so I believe that while investors would still position in the fixed income markets, there is also going to be some more positioning in the equities market.
And talking about rates at this point, looking at the body language of a central bank MPC, they've said they'll do whatever it takes to bring down inflation at this point. How much wiggle room do you think they still have when it comes to interest rate hikes?
Okay, so remember last year when the CBN when Olayemi Cardoso said that the mandatory meeting, or at least number of times they're supposed to meet in a year, is 4, and any other one would be if there is a need to. So far this year they've had 3 meetings. I expect that maybe they've done 750 also. Year to date, right? So I believe that there is still room for some more hike, but not so aggressive, not as aggressive as we've seen. Even in the analyst community, what a lot of people are saying is that we expect a hold soon because of expectations of lower inflation. So there's just going to be a little less aggressive hike in rate.
And definitely, before we start thinking about rate cuts, because we're already seeing in the U.S., we're seeing investors trying to get when the U.S. Fed are going to start cutting rates. They've pushed out down the year, but who knows? It might actually come this year, this point, or maybe next year. But looking at your analyst community at this time, when are you seeing any time, or maybe how many years are you seeing maybe the MPC will start thinking of cutting rates at some point in Nigeria, or could it come sooner than expected?
Okay, so expectation for rate cuts is largely dependent on what on the CBN's ability to achieve their mandates of stable prices, right? Because it's not as if they are just cutting rates or hiking rates without any cost, right? They are trying to achieve stable prices, maybe even exchange rates and all of that. So I believe that the monetary authorities would continue to be on the watch for different data, inflation data, even seeing where our production is like, GDP, is like. So unless all of these things, and of course there have been different measures by even the fiscal authority, generally trying to ensure that rates are down. There's some alleviation of different inflationary pressures. So I believe that this will, continue to be on their what's it called now? Like it would be on their radar. They would continue to watch all of these different unfoldings to see, okay, when the right time to cut rates would be.
Right. Well, in my mind, I see a long time, but who knows? At this point, inflation might just automatically start coming down at some point. Thank you so much, Matilda Adefalujo. She's the investment research analyst at Meristem Securities. Thank you so much. All right, let's look at some other stories now. Top stories this week. We see the newly sworn-in president of chairman of Governing Council of Chartered Institute of Stockbrokers, Mr. Oluwapo Dada, and has keyed into the vision of the President Tinubu-led administration to grow Nigeria's economy to $1 trillion. Mr. Dada, who was speaking after he was sworn in as the 13th president, believes that the government can raise as much as $500 billion through the capital market. However, there are steps that must be taken to deepen the domestic economy.
The federal government of Nigeria, under the leadership of His Excellency President Bola Ahmed Tinubu, GCFR, has articulated his vision of attaining $1 trillion economy during his tenure. To do this, the economy must attain a double-digit growth in gross domestic product. I strongly believe that these objectives are attainable. However, in doing this, 2 crucial steps should be taken. First, the government must create the enabling environment based on universally accepted ease of doing business metrics. In this regard, 3 areas must be highlighted. Number 1 is the rule of law. Number 2 is infrastructure. And number 3 is technology. It is of great concern that the size of the informal sector is so large in Nigeria. The implication is that a lot of tax revenue that should ordinarily go to government is lost, while the mechanism for implementing monetary and other strategic government policy is significantly weakened. It is therefore imperative that the size of the informal sector in Nigeria be substantially reduced if we are to attain the objective of accelerated GDP growth.
All right, to other stories now. The Nigerian Exchange Group PLC has announced the appointment of Mr. Jude Chemeka as the substantial Chief Executive Officer of the Nigerian Exchange Limited, that is operating exchange subsidiary. The appointment was effective July 1st, 2024, following the Securities and Exchange Commission approval. Since January 1st, 2024, Mr. Chemeka has been serving as the acting CEO of the NGX, succeeding Mr. Temi Popola, who transitioned to the role of Group Managing Director and Chief Executive Officer of the NGX Group. And Fidelity Bank PLC has emerged the first bank to publish its 2023 ISSB Compliance Sustainability and Climate Report on the Nigerian banking industry. The report, which is posted on the bank's website, provides insight into the bank's governance strategy, risk management metrics and targets around sustainability and climate-related risk and opportunities, human capital, community efforts, amongst others, in the 2023 financial year. It will be recalled that Fidelity Bank was recently listed among the top Nigerian banks in ESG performance, according to a survey commissioned by the Independent Project Monitoring Company. And that's the show today. Thank you so much for watching for the first week of July. Definitely fingers crossed for what happens in the market for the second half of 2024. I'm Ladi Williams. Remember, if you must sell, find the top. Bye-bye.